Okay, let's talk about silver because right now, everyone is talking about it. The charts are going wild, the price is surging, and you're probably hearing all about this massive breakout. But what if I told you that everyone is missing the real story? What if this whole thing is a trap? We're going to break down what's really happening behind the curtains. Let's get into it. So, check this out. As of Saturday, January 10th, 2026, silver closed at $79.79 an ounce. That was after a nearly 6.2% explosion in a single day. The whole commodities world is buzzing, thinking, this is it. The bull run to triple digits is finally here. But what if that's not what's happening at all? And this quote right here, it just nails the entire idea of what we're talking about today. That $80 price tag everyone's so excited about, that's just a symptom. It's the surface tremor. The real story, the disease, well, that's like an earthquake deep down in the very structure of how silver is even priced. All right, so first up, let's look at what everyone can see, the thing that has all the traders so hyped up. This is the surface level story, the symptom that has everyone's attention right now. I mean, just look at this. The price action has been absolutely relentless. Silver has shot up around 26% in just 1 month. Now, for a huge global commodity like silver, that is not just a little blip on the radar. That's a sign that the market is being forced to completely rethink what this metal is actually worth. And then you zoom out, and wow, the picture gets even wilder, up over 150% year over year. We're not talking about a normal cyclical upswing here. According to the source, this is a total regime change. The game has completely changed. But here's the technical detail that really matters. That breakout past the $77 level. This wasn't just another good day. This was a structural breakthrough. It completely shattered a multi-year ceiling that had slapped down prices again and again. Silver didn't just poke its head above it. It blasted right through, held its ground, and kept going. That's how you know a breakout is the real deal. Okay, but this is where the story takes a really interesting turn. Because this incredible chart action, it's not just a bunch of traders pushing buttons. It's the visible sign of something real happening in the physical world that, frankly, most people are missing. You see, the key thing to get here is that this price breakout isn't happening in a vacuum. It's just the tip of the iceberg. The price action is a visible symptom of a deep structural deficit in the physical market, a problem that's been building for years. And if you know where to look, the proof of this shortage is absolutely everywhere. Global inventories, the big vaults in London and Shanghai, they're near multi-year lows. The COMEX, the main U.S. exchange, has been bleeding physical silver for months. Meanwhile, demand from industries like solar and electric vehicles is just soaring. And here's the kicker. You can't just swap out silver for something else in that tech. This isn't just speculation. This is the price getting dragged upwards because there just isn't enough physical metal to go around. All right, so just when you think you've got it all figured out, shortage, breakout, to the moon, right? Well, not so fast. We have to introduce this weird, powerful counterforce that complicates the whole story. It's a mechanical selling pressure that has nothing to do with supply and demand. We need to talk about something called index rebalancing. Now, this is a kind of behind-the-scenes force that most people have never even heard of. Think about those giant commodity funds people invest in. They follow a strict recipe. And when one ingredient, in this case silver, rallies so much that it becomes too big a piece of the pie, the fund's rules force them to sell it. They have to do it. It's not a choice. It's an automatic, robotic process. And here's how it works. It's pretty simple. First, silver's massive rally makes its weighting in these funds swell up. Second, the rebalancing formula gets triggered. And third, these huge funds now must sell billions of dollars in silver futures. And I gotta stress this is not them saying, we think silver is going down. It's just math. It's a forced sale. So what do you think happens when you have this massive robotic selling pressure slamming into a market that's trying to break out? You get chaos. You get these wild price swings that confuse everybody because neither side of the story, the bullish shortage or this weird selling pressure, can fully explain what's going on. And what this chaos really exposes is something even bigger. There are basically two different silver markets running at the same time. And right now, they are telling completely opposite stories. On one side, you've got the paper market, futures contracts, ETFs. This is the world where all that mechanical index selling's happening, so it looks weak, like it's cooling off. But then you have the physical market, actual bars of silver needed by actual industries. And that market is screaming tightness. It's getting stronger by the day.
They're both supposedly the same metal, but they're living in two different realities.
And if that wasn't enough, this gap between the paper and physical worlds is getting even wider thanks to policy. Recent export controls from China have basically created a one-way street. Silver can flow into China, but it's not flowing back out. That just makes the physical metal available to the rest of us even harder to find. So let's recap, right? We've got a confirmed breakout, a huge physical shortage, and this weird temporary selling pressure. So what happens when all these things crash into each other? Well, the source material lays out a predictable four-phase sequence of events. According to the source, we're in phase 1 right now. This is where the mechanical selling creates a ton of volatility and shakes out all the people who get scared easily. But here's the thing. This pressure has an expiration date. In phase 2, that selling just stops. And that's when phase 3 kicks in. The underlying physical shortage takes back control and forces the price to violently gap higher to catch up with reality. And by the time we get to phase 4, well, that's when the mainstream media finally figures it out. But by then, the big move is already over. And this right here is maybe the best way to think about the whole thing. This selling we're seeing right now is like the ocean water pulling back from the shore. It looks weak, it feels dangerous, but that massive underlying wave, the physical shortage, is still out there building momentum. And once the selling stops, that wave comes roaring back. Which brings us to the end game, the price target. And look, this number is going to sound crazy to most people, but the argument is that it's based on cold, hard math, not just hype.
$150 per ounce. So, how on earth do we get there?
Well, the math is all about the fundamentals. The market is in a structural deficit. It's using about 200 million more ounces a year than it's producing. Global stockpiles are already running on fumes. And the really crucial part is that industrial demand is what economists call price inelastic. What that really means is companies making solar panels or electronics have to buy silver almost no matter what the price is. There's no substitute. So that $150 level isn't just a guess. It's the calculated price where the pain gets so bad that these essential industries are finally forced to cut back production. It's the price that forces demand destruction. So what's the takeaway here? The path to that inflection point is probably going to be chaotic. The selling pressure we see right now feels like a lot of risk. But if you understand the forces at play, this temporary seller meeting a permanent shortage, it forces you to ask a really important question. In a market like this, is the volatility you're seeing really risk, or is it opportunity in disguise?